Hello dear traders. To recover after recent considerable correction, the US main stock market index needed almost 750 trading sessions. The bottom was reached on October 13, 2022. Notably, the optimism about a key rate cut by the Fed has vanished and does not boost the stock market as it did during the Santa Claus rally. Nevertheless, the bullish momentum seen last week remained in force and allowed Wall Street to hit new highs. UBS Global Research, a Swiss financial company, increased its year-end target for the S&P. According to the forecast, the index may climb by 8% this year to trade at 5,150 points. Earlier, analysts at UBS assumed that the S&P would close the year at the level of 4,850 points. However, expectations of lower inflation and interest rates, as well as a stable growth in the US economy, made analysts revise their predictions. After tepid trading seen during a shortened previous week, the S&P started rising only late on Friday. In the first part of the week, the index was closing sessions with declines and was hovering within a narrow range of 4,720 - 4,800. However, on Thursday and Friday, the S&P showed a stable rally. As a result, the indicator ended last week with a jump of more than 1%. At the same time, the S&P also updated its all-time high, which was recorded more than 2 years ago, on January 4, 2022. Yesterday's trading on Wall Street closed with a new record at 4,857 points. What revived the US stock market? Judging by macroeconomic reports, the US regulator has neither reasons nor intentions to cut the benchmark rate at a rapid pace. On the contrary, almost all the speeches provided by the Federal Reserve's officials were rather hawkish. For example, one of the Fed's governors, Christopher Waller, said that there should be no rush to cut rates and that the central bank should proceed methodically and carefully. In other words, the Fed should not make the sort of large, fast reductions used when it's trying to bail out the economy from a shock or pending downturn. In addition, forecasts for the timing of the first key rate cut were moved 2 months forward. According to the FEDWATCH tool, yesterday the likelihood of the key rate cut in March was just 41.5%. For comparison, before Christopher Waller provided his speech, the possibility of such a decision was estimated at 73%. Curiously, the likelihood that the Fed will lower interest rates in May totals 83%. In the short term, speculative sentiment may increase, thus supporting the US stock market. However, in the long term, there is hardly any reason for optimism. At present, the US indices are benefiting from optimism about the US economic outlook and expectations of good quarterly corporate results. Reports released last week showed an increase in consumer sentiment and retail sales. At the same time, annual inflation expectations disclosed by the University of Michigan fell to 2.9% in January, the lowest level since December 2020. The stronger than anticipated economic reports have raised hopes that the United States will avoid a recession. Therefore, the Dow Jones industrial average resumed gaining in value after a slight decline of 0.25% in the first half of last week. On Friday, it also closed at an all-time high at around 37,864. On Monday, the market sentiment was also bullish, with the Dow Jones testing a new record high of around 38,100 points. At the same time, United Airlines announced on Monday that it would lose money in the first 3 months of this year as it's suspending flights on its Boeing 737 MAX 9 aircraft. For reference, this month a panel exploded on one of the MAX series planes. Since then, United and Alaska Airlines have cancelled hundreds of flights and continued to incur losses. As a result, the shares of Boeing itself collapsed, and other corporations were also seized by the crisis. For example, United Airlines has said it may lose about 35-85 cents per share in the first quarter. This is worse than analysts predicted. Most likely, American Airlines will face a similar situation. The company will issue its quarterly report this week. Shares in the technology sector were the main driver of the U.S. stock market. The semiconductor companies index soared by more than 7% last week, thus boosting the NASDAQ by 2.7%. From January 17th to January 22nd, its price rose by almost 1,000 points, from 16,500 to 17,400. Yesterday, the index shares continued to trade in the green thanks to lower yields on U.S. government bonds. The high-tech NASDAQ also found support in a positive report issued by semiconductor foundry TSMC. Thus, the shares of chip manufacturing companies became the main driver of Wall Street's growth. Nvidia shares climbed by 1.9% amid optimism in the field of artificial intelligence. Meanwhile, TSMC's depository receipts advanced by 9.8% on Friday. TSMC, the world's largest microchip manufacturing company, plans to increase revenue by more than 20% in 2024. Shares of other chip makers also gained in value. Broadcom, Qualcomm, and Marvell Technology added more than 3.5% each. Apple's shares jumped by 3.26% after UBS Global Research upgraded their company's rating from neutral to buy. The rise in Apple's shares allowed the information technology sector of the S&P index to grow by 2% and reach a record high. By the way, at the time of preparing this review, the results of 85% of the S&P index companies had already exceeded market forecasts. Since interest in the artificial intelligence field is rising, other major technology companies are likely to disclose strong reports. Intel, IBM, and Netflix are due to publish their data this week. General Electric, Johnson & Johnson, Procter & Gamble, Tesla, and others will also attract investors' attention. Positive corporate earnings reports at the beginning of the fourth quarter will be a favorable factor for the market as a whole. Watch our next releases and fresh information. Our weekly review on the US stock market has come to an end. Don't forget to leave your comments under the video and ask questions. The InstaForex team is working for you. We wish you a good working day and hope to see you next week on January 30th. Stay tuned.